Hi, everyone. Welcome to the latest Carson's Take 5. Ryan here. Sonu is currently traveling, so he couldn't quite join, but I'm going to talk about the latest on tariffs. Obviously, the time I'm recording this and the time you're going to listen to this, there is a lot of fear that's out there, right? The Liberation Day on April 2nd came. 10% tariffs across the board, and then reciprocal, that starts on April 5th, and then on April 9th, reciprocal tariffs, and that's based on different countries and different ways they calculate all of that. The reality is the market's reaction, right? So that was on Wednesday. So Thursday morning time, I'm doing this. A lot of red out there. A lot of red across the board. United States is down significantly. Other parts of the globe, but honestly, you look at the early reaction to what we're seeing right now, purely from a stock market point of view. It's a similar situation to what we've been seeing this year, and that is other parts of the globe are actually doing quite well relative to the United States. For 2 years, the United States did amazing. Let's not forget, 2 years in a row, the S&P 500 gained at least 20%, well over a 70% gain from the October 2022 lows until the February 19th peak. Now, the time I'm recording this, stocks are down more than 10% from the February 19th peak. We call that stocks in a correction. We've kind of talked about this and said externally on our team, we thought 2025 would probably have a 10% peak to trough correction at some point during the year because we didn't see one last year. And we've seen such a strong rally. Now, listen, we get it. The four most dangerous words, Sir John Templeton, this time is different. If you look at the potential effective tariff rates, they're the highest we've seen in a generation, in a very, very, very long time. And that has clearly upset the apple cart and driven so much of this volatility. But again, when you peel back the onion and you look around, at least as of the first quarter, now I know things are lower, to start April here, but as of the first quarter, only two groups were significantly down on the year: technology and what was the other one? Consumer discretionary. Consumer discretionary and technology were both down well over double digits. You had two groups virtually flat, 7 groups up on the year, and fairly significantly in some cases. 9 sectors were outperforming the S&P 500 the first quarter. So yes, if you're tech heavy and some of the Mag 7 and some of the previous leadership, it's clearly been a disappointing year. But after gaining 20% a couple years in a row, to see stocks, the first quarter or so down about 4%, and now I know some follow through here with the jitters around Liberation Day. At the same time, it's important to kind of put some context around this. Also, one of the things Sonu and I have been preaching, right? Clearly, if you own some stocks, it's been a rough year, depending on where you are. But overall, yes, it's been frustrating in the U.S. point of view. But look at globally, right? In the first quarter, Europe is up 12%, Africa up 13%, emerging markets, China up significantly. Virtually all markets except for the U.S. and India were higher in the fourth quarter. Also, then you look around, diversifiers, right? We've talked a little bit about this. Diversify your diversifiers. What made 2022 such a rough year, besides the fact we had a bear market, right? We had a bear market, generational highs in inflation, high interest rates, not fun at all. Bonds, which are supposed to help you sleep at night, did not do that in 2022. Bonds had a terrible, terrible year. 2022 was one of the worst years ever for investors. Okay, 2008 was horrible. Stock market lost 40%. Bonds did pretty good. They gained double digits. Not saying it made up for that, but it helped. 2022, that wasn't the case. Where are we right now? Right, bonds are up nicely on the year. And as of the time I'm doing this on Thursday morning, when the stock market's selling off hard, bonds are doing really, really well. Yields are going lower. Now, the yields are going lower because of concerns over potential growth, right? A growth scare, I guess we could call it. Worries that the economy could be slowing with some of these tariffs and the back and forth and the potential trade war. And honest to goodness, just the uncertainty. Now, we've got a little more certainty out there because we kind of know what the plan is. At the same time, there's still a lot of uncertainty. Small businesses, I know a lot of small business owners probably listening to this still don't know exactly what they should do or when you should do it. And the uncertainty is really, really creeping in. And I've said this before, markets can rally on good news. They can even rally on bad news. 5 years ago right now, go look at our country's headlines. Horrible headlines. Yet, April of 2020 was one of the largest monthly gains in the history of the stock market, with probably some of our worst headlines our country's ever seen. So markets can go up on bad news. Where they struggle is with uncertainty. Now, again, we've got some more news, a little more concrete news out there, but it's clearly leading to kind of a sell first, ask questions later mentality. And that's kind of where we are. Now, to kind of wrap this up, there is a lot of uncertainty out there. There's a lot of fear. If everybody's thinking alike, somebody isn't thinking. General pattern, I like to use that. We keep this fairly high level. We look at, flows. We look at things like put to call ratios. We look at investor sentiment polls to get a gauge on sentiment. There's no one perfect indicator. Taking a broad swipe, there's a lot of fear out there, and rightfully so. Right? When you see stock markets doing what they're doing, it's going to cause a lot of fear. Worry about the economy is causing a lot of fear. Uncertainty out of Washington causing a lot of fear. But once everyone's all, fearful, a lot of times that's kind of how bottoms form. Doesn't mean we're at the lows. Doesn't mean you can't have a little bit more pain. But I think we're getting very, very close to hopefully a pretty major tactical low with all this over-the-top negative sentiment. Then we get some good news. Now, what could the good news be? Let's see how I'm doing time-wise. I probably need to wrap this up. See, without Sonu here, I just keep talking and talking. I don't even see the timer down there. I don't even know how long I've. Oh, there's the timer. It's up there. Probably need to wrap this up, but there's a lot going on here. What could be a good driver? We think the realization the economy is not going into recession. There's the worries about a recession. There are cracks out there. Yes, initial jobless claims just came in better than expected. We're not seeing major cracks in the labor market, at least as of now. In a couple weeks, we're going to start up earnings season. Right? What's corporate America say? How are consumers doing? How are things happening out there? Is anyone really canceling their summer vacation because of tariffs? Somebody might be, right? But I think mostly the backdrop of of households and of corporate America, the balance sheets, I should say, are still in really, really good shape. Doesn't mean we can't have a slowdown. Doesn't mean we can't have a recession. We absolutely could have a recession. I mean, we could. That's not our base case. I'll be very clear there. But of course, there's always a chance of something like that. And if it were to happen, we've said before, households' balance sheets are honestly in pretty good shape. Corporate America balance sheets in pretty good shape. But looking at the glass half full type of mentality here, maybe we get some good news, right? Maybe we get some positive earnings coming up in a couple weeks here. That the realization that this is a growth scare. Historically, the first quarter for the last 10 years or so, you can look it up. I mean, first quarter is usually kind of one of the weakish quarters from an economic point of view. That's GDP, right? How's the economy doing? We see weakness in the first quarter, and then you kind of see a rebound. Well, we're seeing some weakness, clearly, in the first quarter from the economy. But is it cracking? We'd say no, not yet, but we need to follow the data, continue to see what's happening out there. All in all, we are very aware that the headlines, the uncertainty, and just the fact that there's a lot of red out there after a couple of years of being quite spoiled with a lot of big gains. And if you're heavy in the big technology names, which did so well, it really has not been a fun start to the year. But again, that's why we preach being diversified, why we preach rebalancing. Don't always chase a shiny object. Look at some other groups that maybe haven't done as well. Those are the groups that are doing really, really well this year, honestly, the ones that have kind of lagged the last couple of years. So we're seeing some of those things. And from a global point of view, there's a lot of stock markets around the globe that are doing really, really well this year. And that's something to remember. So the big question, I'll finish on this. The big question is, okay, you've got the U.S. down here, and honestly India, but we'll just say the U.S. down here, and a lot of other groups up here, a lot of other countries' stock markets up here. Is everyone going to pull down and catch up with the U.S. on the downside, or is the U.S. going to potentially catch up to the upside? I mean, believe me, that is the $64,000 question that we are asking ourselves literally every day, every hour. We continue to think, though, the U.S. is still pretty solid, right? We still have a strong economy. We still have a lot of things going for us here. The uncertainties out there, absolutely. But let's not forget, President Trump ran on three things, but really three, well, more than three, but three big ones that the market was talking about a lot. Deregulation, potentially lower taxes, and tariffs. Maybe not in that order, though, right? That's not the order we're seeing it in. So there are some potential positive other factors that could come later this year for out of Washington that can, I don't know, offset the tariffs is the right way to put it, but at least it can be a positive along with the realization our economy is likely going to avoid a recession. And again, we still think, stocks can bounce back here nicely. Don't forget, on average, I've gone a long time. See, without Sonu, I go a little long, but hopefully there's a lot of good stuff in here. I hope you're getting something out of this. You see a 10% correction peak to trough on average once a year. Right? We're in there. We're having it, right? Again, we didn't have one last year. Early in a post-election year, where we are now, right now, tends to be weak. Early after a 20% rally the previous year tends to be weak. The first quarter, the last 20 years or so, has historically been quite weak as well. So there are some things out there that said maybe we could have a stub your toe, kind of moment. Clearly, we are having that now. Now the reality again is, do we fall into recession or do we not? We would still say we don't. So in all likelihood, we're going to look back in a year and think, okay, that wasn't fun. Liberation Day wasn't fun, the reaction. But at the same time, we saw something quite similar in 2018. We saw a very quick peak to trough correction of over 10% back in 2018 when the tariffs first started. Market kind of rallied, made a bottom in the middle of April or so back in 2018, and then rallied back to new highs by September or so of that year. And we wouldn't be overly surprised if something like that potentially happened once again. So with all of that, there was a lot of things out there. There's a lot of news out there. There's what's good, what's bad. Uncertainty truly is the word of the day, and that's why the stock market's reacting like it is. But once we get a little more forward, maybe get a little more certainty the economy is doing okay, and that with all that negativity out there, that can be a potential driver that'll open the door for potentially a nice move higher over the coming months in the stock market. So with all that, this is the latest Carson's Take 5. We appreciate it. Thank you for listening. And Sonu will be back next week, and we'll probably be talking about tariffs again. I've had to take a wild guess, but we'll see. But we'll be here next week. Take care, everyone. Thank you.